global tensions pushing those oil prices higher and inflation risks resurfacing, many pre-retirees are wondering what it means for interest rates and therefore the reliability of their income streams. Well, to help us unpack it all, we're joined by Michael Frearson, Head of Fixed Income at Real Asset Management. Welcome. Nice to have you here.
Thank you. Love for having me.
Okay, so let's start with the global picture because clearly there is a lot happening. It's hard to even keep up with the headlines. If I'm sitting here and watching as an Australian retiree, what does it mean for me?
Yeah, well, there is a lot happening in markets right now. And that was a good summary just before from Christopher Kent from the RBA also. But effectively, we're in the middle of a supply shock with oil, with what's happening there with the geopolitical tension. So that's resulted in a big change in inflation expectations, and people have seen that specifically in the price of like petrol, but that will gradually flow through to the price of other transportable goods, which is why the Reserve Bank's needed to raise interest rates like it has. And additionally, from an investment perspective, there's been a big increase in risk premiums. So equities have been quite volatile, and credit spreads in publicly traded credit securities have been quite volatile. So in general, it's been a pretty a big increase in risk aversion, which has been weighing on markets.
Yeah, so the risk aversion is real. We feel it every day to varying degrees in different asset classes. But one thing that we know, and I think Christopher Kent alluded to it, is that the real fear is that these inflation expectations get baked in, and then that will impact interest rates. How do you see this playing out?
Yes, certainly. So that's certainly why the Reserve Bank of Australia moved to increase the cash rate in March to 4.1%. So they had already increased the cash rate this year once from 3.6 to 3.85%. That was due to the demand pressures from the domestic market. But given that supply shock, they've also moved to increase it again quite quickly to 4.1%. The actual market is pricing in another 2 to 3 rate hikes this year. So in the short term, the market often gets a bit overexcited and it's looking to price in quite an aggressive rate hike cycle. At this stage, we don't expect 3, but we do expect at least 1, most likely in May, and potentially another follow-up one in August. But it's very hard to predict with any certainty what's going to happen in the Middle East. So if things settle down, there's a chance we may not need that second rate rise.
Yeah, because it will hopefully get some of that premium taken off of the price of fuel. So there is so much uncertainty, and it's really impacting, if you would have heard the previous interview, everything from bond prices to term deposit expectations. So what does that mean for pre-retirees?
Yeah, well, from the fixed income perspective, the higher for longer rates environment can actually be quite positive for income investors. So if you're investing in floating rate income streams linked to the cash rate, its most simplest form is a term deposit, but then you can get floating rate like credit funds. You actually benefit from that increase in rates, and generally these funds can be quite stable depending on what they invest into. So the thing about fixed income, there's a very wide range of solutions. So you really need to understand what you're investing in and if it's sensitive to movements in either interest rates or credit risk premiums.
And not all credit funds behave the same. So why and what would you expect to struggle in this very volatile, uncertain environment as opposed to those that might hold up better?
Yeah, well, it's interesting that over recent weeks we've seen high quality government bonds struggling. So often in times of extreme volatility, they don't actually provide a hedge to your portfolio when rates are going higher. So they've fallen and not provided diversification benefit to portfolios. Additionally, publicly exposed credit spreads have been have increased because they're correlated with equity markets. So the traditional publicly traded fixed income assets haven't been performing for investors.
So, where does RAMHA, I don't know, how do you say that properly? Do we say it as the acronym?
Yeah, so it's an ASX ticker, so RAMHA is how to say it.
Yeah.
So RAMHA is RAM Secured Income Notes which trade on the ASX. So they're a senior secured note issued by RAM to pay investors monthly regular income, has a certain maturity date in around 5 years' time, and is also backed by a high quality underlying portfolio of secured home loans. So we think those characteristics are quite attractive in the current market because it's floating rate, it's got security, and it's also got the maturity, which our investors know they'll get their $100 back in time.
So is it fair to say that it's on the more defensive end of the spectrum?
Yes, it's a very defensively structured security at the first level. So the security has a number of structural benefits. In particular, there's $10 million worth of loss protection in the structure, with the issuer holding the first loss in the balance sheet. Additionally, the underlying portfolio is very high quality. So it's a diversified portfolio of approximately 7,000 residential Australian mortgages. So we know exactly what's in there. We know it's performing very well. It's actually performing historically a lot better than the major banks, and we can prove that with the data. So we think it's a very defensive portfolio to provide that regular income that retirees need. The other key benefit of it is that it is floating rate. It pays a 3% premium to the cash rate. So back to the earlier point, when cash rate goes higher, the income stream goes higher, which helps the retirees, meet their higher cost of living.
So that's really interesting. When it comes to, some of these products that are available, so what you're saying is this is purely exposed to the Australian housing market, so there's no offshore SMEs. Actually, there's no onshore SMEs in there as well.
Correct.
Or either.
So yeah, it's a key differentiator of our security compared to some others in the market. It is very simple in investment portfolio, which is 100% Australian, 100% senior secured first registered mortgages are backing the portfolio. So it's quite different than a number of the peers, which have high exposures to potentially offshore exposure. They might have leverage in their portfolios, they might invest to corporates, or they might do property development lending. And all of those things are excluded from our investment universe.
All right, so pre-retirees watching right now, waking up to very uncertain headlines, oil prices rising, cost of living pressures rising. What's the key message?
Yeah, the key message is obviously don't panic in times of volatility in markets. So if you are concerned about your portfolio, firstly speak to your advisor. But if you are looking for stability in your portfolio, think about adding more defensive, uncorrelated investments in your portfolio, like RAM's secured income note.